Now, I'm willing to take that risk in part because I know a big chunk of people who will hate me no matter what, but mainly because I like where we are right now. While I think we could test June's lows, I mean, even tonight we had weak numbers from Salesforce.com, and they were weak, and weak numbers from NVIDIA, and they were weak. There's plenty of reason to be apprehensive, but I'm betting the market will bend, not break, through a rough September, and when we get through that period, that June low will hold. Now, it won't be easy because we got a bunch of new negative factors. But I want to stake my claim today ahead of the Jackson Hole speeches from Fed Chief Jay Powell and his central banker compadres on Friday. Why? Well, remember the context. In mid-June, we had just gotten a triple rate hike that week on June 15th. And that's a pretty staggering move by the Fed. It shows that the Fed meant business. Now, historically, we don't get a lot of 75 basis point bumps. Wall Street lapped it up, though, because it told us the Fed's taking inflation really seriously. But then the next day, there was tremendous buyer's remorse in the stock market. Investors seemed to assume that things were still very much out of control. Okay? They figured we'd get hit with a series of additional rate hikes, aggressive ones, and therefore we had to steel ourselves for some real discouraging earnings reports come July. Why not, right? I mean, it makes a lot of sense. Fed tightening, and we're going to go into a gloomy period. The reports are going to be bad. The sell was nasty to the point where it brought down virtually everything. That's one of the reasons why I'm so confident that these June lows that we're talking about right here might actually represent a bottom, because so many people capitulated and so many hedge funds got short. Let me put it in perspective. First, we tend to look at stocks in a vacuum. We want to know how the S&P 500 is faring and how our individual stocks or mutual funds are doing. But we rarely look around at other asset classes, which is why investors often make big mistakes, like dumping stocks in the lows in June when we got that first 75 basis point rate hike, instead of buying them. If you only looked at the stock market, you would have missed what caused the bottom. While stock owners were skeptical about the impact of that rate hike, bondholders and commodity traders had a very different reaction. They decided that Jay Powell was no longer to be trifled with. People bought 10-year treasuries hand over fist, so the yields started coming down. At the same time, oil prices spiked, and they rolled over. I mean, it's rather amazing. Here you have the first spike, and then the second spike, and then oil rolled over, even though it was in the 120s. Given how important the price of crude is to the inflation food chain, including day-to-day inflation that's right in your face at the pump, we should have realized that this was a monumental story. We never heard the end of it when oil was on its way up. Somehow it became a non-issue on the way down. That was wrong. Bond market knew that. Okay, so you have to ask yourself, how did so many investors miss this? You see, because the decline in oil had nothing to do with the United States or even the well-covered OPEC. It was all about Russia striking gold with India. We thought Russia wouldn't be able to find markets for its sanctioned oil outside of China. That would have bottled that oil up. Oil would have gone, of course, through the roof. But India couldn't resist that cheap crude. That meant the world price had to come down, and it collapsed. Bond guys, sensing a peak in the most important commercial commodity, just kept buying bonds and buying bonds, causing the selling in stocks to stop because the bond market is joined at the hip with the stock market. How about the worries of the stock market investors that the second quarter numbers would be terrible and the guidance would be worse? Because that's what normally happens when the Fed tightens like crazy. Well, you know what? It hasn't happened yet. It didn't happen. This earnings season, the one that just ended, vast majority of companies did fine. A huge number of beat and raised quarters. Very few true disappointments.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.